If you look at the stock market over the last decade, you'll see two completely different realities. Most investors experience a steady, predictable climb, but a few are holding assets that violently swing upward, completely breaking the boundaries of the chart. Standard advice tells us to buy an S&P 500 ETF, like VOO, and hold it forever. It's solid guidance, yet it ignores a significant reality. While VOO earned a respectable 15% a year, a handful of specific regulated ETFs quietly compounded at over 34% annually for 10 years straight. This chart shows exactly what those different returns look like in real dollars. If you invest $500 a month for a decade at a 7% average return, you end up with roughly $86,000. Run that same $500 a month at a 15% return, and your balance jumps to $138,000. But at 23%, you're north of $220,000. Same discipline, same money, completely different outcome. This wealth gap stems from structural ETF selection. Moving beyond the luck required for individual stocks or crypto, you might be leaving serious money on the table without even knowing it. Now, past performance does not guarantee future returns. No one can promise the next 10 years will look identical to the last 10. But historical returns are highly useful. They reveal patterns, consistency, and exactly how these funds behave when the market crashes. Success requires matching a fund's internal mechanics to your specific risk tolerance, looking past the simple allure of the highest historical number. We'll start with the broad foundations. These are the set-and-forget funds designed to capture the overall growth of the market with practically zero maintenance. The broadest option available is VT, the Vanguard Total World Stock ETF. It automatically balances over 10,000 global stocks based on their market capitalization. You don't have to decide between US or international exposure. The market decides for you. If you want to separate your international exposure, there's VXUS. Most US investors put 100% of their money into American stocks, but the rest of the world produces roughly 40% of global economic output, and VXUS captures all of it. This gives you ownership of over 8,700 companies across Europe, Asia, and emerging markets. These are dominant, vital companies like Samsung, Taiwan Semiconductor, and ASML that manufacture the technology the rest of the world relies on. On the domestic side, VTI and VOO focus strictly on the American economy. VTI buys every publicly traded company in the US, while VOO targets the 500 largest. Both offer extreme cost efficiency, with fees sitting around 0.03%. There's a reason legendary investors consistently recommend broad US index funds for ordinary investors. They provide cheap, frictionless access to the most powerful economy. The S&P 500 also has a structural advantage built into its design. It's self-cleaning. If a company stops performing, the index automatically cuts it and replaces it with a stronger, rising business. You own the winners without having to make a single trade. These broad foundation funds are highly effective. They guarantee you will capture general market growth with minimal effort. The trade-off is that their sheer size and diversification mathematically prevent you from achieving massive, outsized returns. That brings us to SCHD, the Schwab U.S. Dividend Equity ETF. This fund is unique because it actively pays you cash every single quarter for holding it. Instead of chasing high-flying tech stocks, SCHD holds 100 mature, cash-generating businesses. These are highly profitable companies with decades-long track records of paying and consistently growing their dividends. This chart shows exactly why that matters during a crisis. In the brutal 2022 bear market, the tech-heavy QQQ dropped over 32%. During that exact same period, SCHD fell only about 3%. That resilience is structural. Profitable, dividend-paying companies have actual, predictable cash flows backing up their market valuations, which reduces their price volatility when the broader market panics. By holding SCHD, you are consciously sacrificing high-octane growth during tech bull runs. In exchange, you get tangible quarterly income and the psychological comfort needed to avoid panic selling during a crash. If you are willing to take on more risk for higher reward, we enter heavy hitters. These are the aggressive growth satellites, funds that intentionally concentrate their holdings to chase outsized returns. Take SPMO, the Invesco S&P 500 Momentum ETF. It capitalizes on a well-documented behavioral finance concept. Stocks that have been rising rapidly tend to keep rising in the short to medium term. SPMO captures this by following a strict mechanical rule. Twice a year, it evaluates the market to call the slower stocks from its portfolio and buys the new leaders. It constantly upgrades itself to hold whatever the market is currently rewarding. But momentum investing has a severe trade-off. When markets suddenly rotate or reverse, momentum funds crash harder than the broader index because they are heavily concentrated in the exact stocks that just peaked. Then you have QQQM, which tracks the NASDAQ 100. This fund is deeply concentrated in the technology companies that are actively rewriting the modern global economy: Apple, Microsoft, Nvidia, and Alphabet. It's important to differentiate QQQM from pure information technology funds like VGT. QQQM holds companies across multiple sectors. For example, Amazon is classified as consumer discretionary, and Meta is communication services, meaning they are excluded from strict tech funds, but heavily weighted in QQQM. Allocating your money to these funds means betting aggressively on the digitization of the economy. Historically, that bet has yielded 20% annualized returns over the last decade, but it guarantees periods of stomach-churning 30% drawdowns. If you want the absolute apex of risk and reward, you look at SMH. This fund goes one level deeper than pure tech. It exclusively owns the physical foundation that all modern software runs on. Without semiconductors, nothing in the modern technological era exists. Every AI model, cloud data center, and electric vehicle relies on these chips. To capture that specific market, SMH utilizes extreme hyperconcentration. It holds just 25 total companies, creating immense exposure to the semiconductor supply chain. The historical performance is staggering. Over the last decade, SMH compounded at over 34% annually. A $10,000 investment 10 years ago would be worth over $188,000 today. But you have to pay a massive psychological price for those returns. The semiconductor industry goes through vicious boom and bust cycles. When demand temporarily slows down, the entire fund collapses at once, resulting in brutal drops like its 33% plunge in 2022. Because of that volatility, SNH is far too erratic to be a core portfolio foundation. But for an investor with a 10 to 15-year time horizon, it serves as an unmatched satellite allocation for a small slice of your overall wealth. The core truth of the stock market is that there is no free lunch. If you want to capture 34% annual returns, you have to pay the cost of enduring extreme, terrifying volatility. This matrix shows a clear decision framework based on your primary goal as an investor. Focus on the specific column that aligns with your personal investment psychology. If your goal is a stress-free, single-decision retirement where you never have to check the news, your optimal tools are the broad foundation funds. You buy VT, VTI, or VOO, and you let the global economy do the heavy lifting. If your priority is surviving market crashes with minimal panic while generating tangible cash, your optimal tool is dividend income through a fund like SCHD. You trade maximum growth for predictability and quarterly payouts. And if you have an iron stomach and a decade-long timeline, you can allocate a 10 to 15% minority slice of your portfolio to aggressive growth satellites like QQQM, VGT, or SMH. The primary risk to your portfolio is a strategy that breaks your emotional discipline. Pick your profile, build your core, and let the math work.